Hey everyone, welcome in to another daily editorial here on the KE Report. This is going to be a fun one as we are going to recap the Fed rate cut yesterday, that 50 basis point cut, as well as the market reactions on the back of that rate cut, which again, kind of contradictory when we saw what happened the 2 hours after that meeting in markets when they rolled over after popping. And then today on Thursday, boy, oh boy, things are really taking off. Lot of green on my screen. We're chatting right now with Mike Larson, editor-in-chief at MoneyShow. I'll post a link in the show notes for all the upcoming MoneyShow conferences for you all to check out. Mike, give us a recap, your reaction on that Fed 50 basis point cut and now the market reaction. As I said, a bit of a rollover after the press conference, but today, a screaming higher move.
Well, gentlemen, yeah, what a what a market to have here in front of us. It's funny, the Fed. We've talked for a while. I said for a couple of weeks I expected the Fed would probably go 50. This was even before we got some of the CPI numbers and other things that really opened the door to that. And then, of course, the leaks to the Wall Street Journal and other things right before the meeting that suggested, hey, there really is a decent chance they're going to go 50. I think ahead of the meeting, the last check at the interest rate markets, there's about a 55-60% chance, maybe a little higher, priced into the rate futures market that they'd go 50. And sure enough, they did. I look at this cut as essentially being the Fed saying, all right, look, we screwed up. We should have gone 25 in July. So now we're playing catch up, right? It's a Heinz 57 kind of move here. And I think if the Fed had gone 25 in July, which in hindsight they should have, they would have only gone 25 here. So I don't look at it as, holy cow, this is some panic move. It's, all right, we should have started a little bit earlier. Now we're going to play catch up, but we're going to stick with 25s from here on out unless something crazy happens. So when you look at the immediate reaction after the news, I kind of put up on Twitter, on X, and I did a video for our Money Show YouTube channel where I said, look, the sell the news stuff is not odd. If you've been following the Fed for as long as I have, or if you've been trading non-farm payrolls days, Fed days, whatever, you often get some craziness in the immediate aftermath and even for a couple hours after this news comes out. But then you tend to see the real market reaction follow. And sure enough, when you woke up this morning, if you looked at the futures, you saw it in big and bold numbers on your screen. And we've just continued to run since then. I think everything I'm seeing suggests that sort of be bold approach, the Fed basically sticking a soft landing, having plenty of reason from inflation, from the somewhat softer labor market news, to start, normalizing policy, get out of this very high interest rate situation and get back to something that's more normal is justified. And there's all kinds of whinging online and on social media out there, which is shocking to me about, inflation's not coming down. This is panic. This is political, blah, blah, blah. Look, I've been following the Fed for a quarter century. I think that, I get things wrong. I've gotten I've made some really bad calls in the past, but I think the data is sort of validating the thesis that you and I have talked about for a number of months here, which is labor market's softening enough. It's not slipping into recessionary territory. Inflation at the peak in June of 22, the CPI was up 6.6% year over year in the US. That's a hideous number. At last check, it was up 3.2%. That's less than half of the peak. So why would interest rates stay up in that mid-5 zone when inflation's been cut in half? Is inflation to levels that suggest we should have 0% interest rates? Absolutely not. Is it suggestive of interest rates maybe somewhere in the threes, low threes? Yeah, it is. So that's where we're going. And that's what the market's been telling you. I think that's what a lot of people are fighting. They keep looking for the next crisis. Sometimes maybe things just aren't terrible. And you know what? We're all in this business to try and make money. My job is to help people try and make money in their portfolio as investors, as traders, help educate them and so on. And I think that people need to just sort of focus on, look, there's times when things are actually good and you should position for things being actually good and make some good money while you can. And I think that's where we're at.
It's a solid point, Mike, and I think that overall that a lot of people have a tendency to be nervous Nellies and be worried that maybe it's not a soft landing, maybe the Fed is panicking, and you do see a lot of that diatribe out there in the blogospheres, on the interwebs. But when you think about this being a series of rate cuts, I guess the larger question is, has the market already priced a lot of the series of cuts expected, which they think it's going to come down 150 to 200 basis points to get the Fed funds rate more closer to the threes than where it is currently? And so if that's the case, what does that mean for the markets in the context that often during a rate cutting cycle, the markets don't stay strong? Is that a risk that people are not factoring in right now?
I think the bond market has come a long way in a short period of time. We're talking about price increases in 30s and 10, or excuse me, yeah, and long bonds and 10-year notes and yield declines. I think, you've seen a lot of that decline, in the bond market already reflect that this sort of newfound optimism. I think that bonds may take a breather here, give back, I don't know, 15, 20 bips in yield on the 10-year, give back a couple percentage points in performance, as these things are digested. But in terms of the stock market, I mean, unlike bonds, which have fixed returns, there's a cap just on how much yields can fall, really. I mean, the stock market, if earnings are going to rebound or pick up as a result of economic growth, if money discount rates are going to go down, if sentiment is still arguably in a few places too bearish, in my opinion, what's to say that you can't get the market to keep rallying as you reprice some of the things people were worried about? And I think that's what we're seeing. I do think this, and I've said this for a couple months now, I do think you're going to see a change in leadership, and you already are seeing a change in leadership, where things like tech, the Mag 7, which were everybody's favorite and could do no wrong for a while, I think those are going to take a backseat, and you're going to see other sectors and ETFs and stocks that had been held back, things like small caps, things like materials, financials, industrials, are going to play catch up, and that's where you're going to get the outperformance. I mean, if you're looking for what to buy, and what to rotate out of, I think you kind of sell down some of your tech stuff, buy some small caps, buy some industrials, financials, some other things that have been left behind, bargains and things like REITs have done very well recently. I think that play makes a lot of sense. They haven't done anything for 18 months. Now they're catching fire. Get into that sector. There's some new ways within the stock market to move some money around while maintaining an overall bullish standpoint. So I think that's kind of the takeaway to me. It's that get into some of these things that previously were not moving, because that's where the outperformance is going to be moving forward.
So, Mike, to your point about people wanting to be bearish, seeing the worst in the markets or in the economy, a lot of those comments also say that the Fed is behind the curve. They're slow to react. They're just late in all their moves. But with this 50 basis point cut, looking at the dot plot moving forward, they're now estimating about 25 basis point cuts in the next two meetings and then cuts all through next year slowly. And the market was, in a way, already pricing in more cuts than they have forecasted to the end of 2025. In a way, has the Fed taken back the driver's seat with this 50 basis point cut?
Yeah, I mean, look, I think what the Fed is showing is that, Powell said this in his press conference, is that they probably realize they're a little behind. And that's sort of my assessment too. Like I said, I think they should have started this process in July. But unlike in a lot of past periods in terms of recent economic history, I don't think they're way behind. And I think that their mission, they really want to stay sort of in line or ahead of where things should go. So yeah, the Fed's trying to grab that sort of baton, that narrative, whatever, and show, look, we're on the job, we're doing what we need to do. And that's, get policy rates back in line with what we've seen in terms of more labor slack and falling inflation rates. Again, I think a lot of people are confused on the idea of falling inflation rates and falling inflation. No, you're not paying as little as you paid 4 years ago for a car today. You're not paying as little as you did 4 years ago for car insurance or groceries or housing or any of these things. But falling inflation means, in Wall Street terms, investor terms, means falling inflation rates. And that's what we're seeing. I don't think we're going to see deflation to the point we're back to 2020 prices. What we are seeing, though, and what the market cares about, is the rate of change and rate of inflation, and that's clearly easing. So I think, the Fed is out there showing, wants to stay ahead of the game, or at least catch up to kind of where things are in the economy. And that's what I think this was. It's a Heinz 57 kind of move. It's catch up.
Yeah, it is a catch-up move, but I guess another question would be, in the series of rate cuts that we expect to see, continued 25 basis point hikes at the future meetings in next year, if the thesis was that hiking rates would bring down inflation, is there a danger that cutting rates actually fuels growth to the point where inflation pops its head back up? Could that cause them to eventually pause? Could we maybe be getting over our skis and expecting just a continuous series of hikes where maybe they may take some time off, just like they did on the hiking side?
I think down the road, sure, if you cut too far, that's going to allow inflation to sort of base and turn higher again. But I think from an investor standpoint, that's taking things too far. You got to look ahead as an investor, but you don't want to look too many cycles or too far ahead. Enjoy the easing cycle and the cooling inflation cycle that's going to be with us for, in my opinion, several quarters before you start worrying about what happens in the quarters after that. So the things that drove inflation up, the massive free money printing, the pandemic, the supply chain, the nearshoring, all the stuff that happened, all those things that combine to give us that nasty run up in inflation, to me, don't come back. A lot of those things. Now we're back to sort of the standard economic stuff, policy rates and underlying economic growth and so on. And I don't think that they're supportive of a 6.5% core inflation rate or a 9% or 8% whatever headline inflation rate. I just don't think they are. Maybe someday down the road, but someday down the road I'll be dead too. So I don't want to worry about that. I want to worry about what's happening in the here and now and the intermediate near term future. So that's kind of how I look at it. I think that once the Fed normalizes, once a year from now, the Fed has stopped cutting, which is probably going to happen. If you look at the futures market, I mean, they're expecting the cycle to kind of last through around this time next year. And then then we assess where we're at. That's when you start thinking, okay, now what's the next step, right? In the meantime, enjoy what's going on now and make money from what's going on now. That's kind of how I see it.
So, Mike, does this rate cut entice people to move money off of the sidelines, out of the money market funds into the markets, no matter what sector you might think they funnel into?
I had a great conversation with Benjamin Tall for this week's podcast ahead of the Toronto Money Show we were just at. And that was his point that, particularly in Canada, as term deposit rates, GIC rates, and things like that come down, it's going to, in Canada, force money off the sidelines back into equities, into dividend-paying stocks, and so on. And I don't see any reason you wouldn't see a similar type of thing in the U.S. as well. A lot of people have been hiding money in bank CDs, things like that. And the banks, even though the bond market anticipates, the banks don't tend to change some of their rates. Well, they're a little slower than the publicly traded markets when it comes to lowering yields, APYs and things. Those are going to start coming down now. So money is going to look for a new home where it can get, where you can earn more money on your money. That is going to favor some things like REITs. That's going to favor, it obviously has favored utilities and so on already. I think maybe that sector, again, takes a little bit of a breather. Maybe bonds take a little bit of a breather and so on. But, I think longer term, again, there's so much, especially in a sector like real estate. I keep coming back to it. I mean, there's so much pessimism. You're still reading stuff about the coming commercial real estate crash. That was a year ago. Like, if you look at the stats from the banking sector, from the Fed itself, going out there and surveying banks, hey, are you tightening standards or loosening lending standards? Meaning, are you more worried or less worried about credit risk and your borrowers defaulting? The peak tightening happened 3 quarters ago. It's coming down now. I mean, opportunistic money, the sort of grave dancers like Sam Zell used to be in the real estate sector, they're buying. What does that tell you? That do you want to miss out on an opportunity in a beaten down sector where the narrative is still negative, but rates have turned, demand, supply trends have turned? No, I don't think so. I mean, it's kind of funny. Just as we're talking, I was calling up the 3-month returns for a couple of different ETFs. The Qs, the tech ETF, okay, it's up 1.2% in the last 3 months. That's fine. IWM is the small cap ETF, the Russell 2000 ETF. It's up just under 12%. And the REIT ETF, XLRE, is up just over 16%. That's the kind of stuff you're going to see, the rotation behind the scenes, where the overall market, I think, does pretty well. But if you're in the right sectors, the right parts of the market, you're going to do much better than well.
Well, Mike, just to that point, I thought a lot of people on our show have highlighted how well REITs have been doing. They've been talking about the financial sector doing well, healthcare, insurance, cybersecurity. Those all kind of, even consumer staples, those all kind of fall into the value sector, not really the growth that you would see in like the tech sector or in a lot of the small caps. So when you think about that, is that people positioning defensively because of the uncertainty around this rate cutting cycle or around the political situation in the U.S., or is it because a lot of those are rate sensitive? Where's the balance there? Because it seems like there is a rotation out of growth and into value.
Yeah, it to me is a broader out of growth into value trade. And I say that because if it was just utilities, just REITs, or just consumer staples doing, that'd be worrying me a little bit. That sort of has a pre-recessionary whiff to it. But again, I just added a few more ETFs to my screen. I mean, the financials ETF in the last 3 months is up 11%. So, I mean, financials are one of those sort of canary in a coal mine sector. If it was more of a credit risk recession worry play and it was all just utilities and staples, that'd be one thing. When you got financials rallying along with those, that's a positive. I mean, I think it's more of an out of growth into value, out of tech into almost everything else kind of thing. And that's what I love to see. And you haven't asked me about it yet, but I might as well talk about it because, who we're speaking to here. I mean, the GDX, the GDXJ, you're up 15, 16% there in terms of mining stocks, juniors and majors in the last 3 months. And boy, talk about a place that there could be some catch up, to what's happening in the underlying metal and gold. I mean, shoot, I love that space.
Oh man, look at how good those stocks did. Just even last week, GDX was up over 10%. The silver miners, SIL, was up over 15%. So they are joining in on this rally. Loop this into currencies and emerging markets, though, because rate cuts you would think would bring down the US dollar. I've listened to some people saying that there's an opportunity in emerging markets as well. Do you see opportunities there, Mike?
Yeah, no, absolutely. The big sort of albatross around the neck of emerging markets beyond just the US dollar has been China, right? I mean, so much of China has been in this sort of private bear market, private real estate bust. And by private, I mean within their borders. Certainly, there are some spillover impacts elsewhere, but it's predominantly what's happening in China as opposed to the last time around when the whole global real estate market fell apart because of the U.S. contagion, what we spread all over the world. So I think the one issue is going to be, can China find its footing in the sort of emerging markets that are tied to that? I do think, yes, all else being equal, the dollar is, a falling dollar is a tailwind for other parts of the market, emerging market, equities and bonds. If you can, put more money into that, or even ex-US developed markets, yeah, I think that these things, it's important, I think, for investors to realize this is kind of a sea change, right? The things that didn't, or the things that really worked are still going to work, but the things that really didn't work are going to really work. I guess that's how I'd sum it up. If you avoided foreign stocks, you avoided small caps, and you were just in big tech and just Mag 7, that was a recipe for massive outperformance for the last couple of years. I don't think it's going to be going forward. So I don't hate tech or anything. I don't think we're in some dot-com crash is coming. We already had that, frankly, as you and I have talked about before. Do you want to be putting money into things that didn't work? 100%. Get into small caps, get more money in there, get more money global, get more money into mining, get more money into materials, things that have sort of lagged. Because in my opinion, that's the kind of stuff that's really going to turn on the jets moving forward.
All right, the catch-up trade finally here. It sounds like there's a lot of opportunities still to make money in this market, but hey, go to those lagging sectors because the tide has shifted. We're going to have more rate cuts, and well, don't fight it, I guess. That's the big takeaway I'm getting from you here, Mike.
Yeah, I mean, don't fight the Fed may be cliche, but it's cliche because it works. And that's in both directions. When the Fed was fighting you, you want to be more defensive. Fed's on your side. Don't ignore that.
All right, Mike Larson, editor-in-chief at MoneyShow. Click that link in the show notes to find out more about some upcoming MoneyShow conferences. Mike, thank you as always for your time. We'll chat again in another few weeks.